Hello, my name is Liz Thompson, and this is IME 315 Financial Decision Making for Engineers at Cal Poly San Luis Obispo. This video is on balance sheets and various aspects related to accounting. Balance sheets falls into the category of reporting and managing profits when we look at the overview of the course. So when we talk about this, basic accounting equation, which is assets is equal to liabilities plus equities, I want to explain a little bit about what this means. So the assets of the firm are those things that you have that help you to generate profit for the company. Now, these would be things like money in the bank, patents you've purchased, machines, inventories, computers, desks, really tangible things that help you to generate profit. Now, this isn't things like the knowledge of a particular person. Like if you hire a really smart person, this doesn't actually go into the assets categories. It's more about the tangible things that you own. Now, those are all the things that are helping you generate money for the company. Now, that has to be equal to who owns this. And the idea of who owns it is there's two types of ownerships. One is liabilities and the other is equity. Liabilities are things like if you've borrowed money from a bank, that you've taken money from them and you agree to pay it back at a certain schedule, at a certain amount with interest. That is liabilities. The other part of it is ownership or equity. And these are people who own part of the company. And that means that if it makes money, it makes a lot of money, they get to keep the money. If it loses a lot of money, they will lose the money. So liabilities holders are protected a little bit quite a bit actually, from the risk of business, where equity holders own all of that risk. So another word for liabilities is debt, and another word for equity is ownership when we look at these items. Now, if we look at something kind of similar and parallel in kind of normal life, one way to think about it is that we actually do this when we buy a house. So we buy a house, we say, oh, I like that house, I want to live there and I want to own it. But most of the time when people buy homes, they don't own the whole home. They actually have to borrow money from a bank to let them buy the house, because you don't necessarily pay $400,000 outright for that home. So what we call that in normal terms is a mortgage. You have a mortgage on your house, and it is a liability. It's a debt. But in general, way you think about this is, let's say you buy a house for $400,000 and you borrow $300,000 on it. That means your equity in the home is $100,000. So that's the portion that you own. You live in the home and you use the home, but your ownership is only a quarter of that home. And it's the same with a business. So in a balance sheet, like we talked about in the previous video, there's going to be two sides of the balance sheet. One is the assets, and the other is liabilities and equity, or the owners of the company. Now again, balance sheets are as a moment in time. In this case, it's 3/31/19. And this looks a little bit different than the Apple balance sheet, but many of the categories are the same. And you have to kind of get used to looking at different balance sheets. There's always going to be assets, liabilities, and equity. There's also going to be a couple other things that are always going to be present. So the first is that it's a moment in time. The second that you need to look at is that you're going to be equating the assets is going to be equal liabilities with equity. You will never see a balance sheet that doesn't have these two items equal. That's very important in a balance sheet, because you're looking at the assets and who owns them. The other thing in a balance sheet, there's often things are divided into current and long-term. In this case, we have current assets and current liabilities. These are liabilities that turn over within 1 year. So like cash, you can liquidate that cash very quickly within 1 year. The same with inventory. You can sell off your inventory in 1 year. But something like fixed assets, those are longer term. Those are going to last much more than a year. They're going to be maybe 10 years or things like that. And then also long-term debt. Some debt is short-term and some is long-term, meaning some is within a year and some is longer than a year. So these are part of the way you'll always see the breakup in the balance sheet. There's a certain category when we look at the relationship between kind of what we think of as short-term or current issues, and that's working capital. Working capital is the difference between current liabilities and current assets and current liabilities. So in this case, the working capital of this corporation is $600, 1,000 minus 400. And that's just a concept we want to understand when people are referring to it. This is the way you calculate it. Another thing you might do with a balance sheet is calculate some kind of ratios. So like we know the Apple balance sheet is quite a bit different than this simple balance sheet, but we can still have ratios associated with these things. One of the ratios that's common to calculate is a debt ratio, and this indicates the riskiness of the company, kind of like who owns the company. Is it owned by the bank or is it owned by the owners? So this is generally liabilities over assets, and this is often expressed in a percentage. So in this case, we take the $900, which is the total liabilities, and divide it by 4,500, which is the total assets of the company, or 0.2 or 20%. So this is a good debt ratio. Usually debt ratios should be below 75%. Different companies have different ways of managing this, but this is a good debt ratio. Another ratio we might want to look at is a current ratio, which expresses the liquidity of the company. Can the company meet its short-term cash obligations? So we look at current ratio by taking not the difference like we did in working capital, but the ratio of current assets to current liabilities. So in this case, we want this number to be greater than 1. For us in this calculation, it's 1,000 divided by 400, or 2.5. So we can just see, yeah, this is pretty good. They will be able to meet their current obligations. So one of the things I'd like you to do is to look back again at Apple's balance sheet, and you can find this in Polylearn, and do a calculation for what is the working capital, what's the debt ratio, and what's the current ratio, so that we can kind of compare it and see what those means. So again, what we've looked at here is the idea of reporting and managing profits in this particular video, and we looked particularly at balance sheets.